Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Monday, the 6th of February. I'm Daniel Lam, your host for the podcast. Just when the macro picture appears to be clearer after the dovish FOMC rate decision last week, the non-farm payroll number threatened to complicate this picture. U.S. job growth accelerated sharply in the month of January, adding a whopping 517,000 jobs last month. For those looking at this with a glass half empty view, this would be a signal for more rate hikes ahead. Indeed, if you look at the asset prices on a close-to-close basis, S&P 500 dropped by 1%, and the US 10-year yield, as well as the US dollar, both rose sharply. However, for those looking at this glass half full, the biggest takeaway on Friday was that it is entirely possible for strong job gains to occur with moderating wage growth, which was at plus 30 bips month on month, in line with expectations, and versus plus 40 bips prior. The pattern of decoupling in NFP and wage growth data has been emerging since the fourth quarter last year. This is consistent with Powell's increasing openness that it is possible for the Fed to meet its inflation goal, even if job growth does not cool from here. So Friday's asset price action was more about profit-taking rather than the start of a genuine sell-off. Looking at intraday price action, for example, the S&P 500 cash market was recovering well from opening at the lows, only to falter in the second half of the session. Technically, it is normal for S&P 500 to retest the 4100 level, which was previously the resistance and now turned support level. The index potentially may take off again to the 4,325 level that we spoke about in the podcast last Thursday. I would also like to remind you that there is likely to be continued short-term rotation of funds into US equities at the expense of Hong Kong-China ones. For the last few sessions, the volume in the Hang Seng Index is nearly twice what we saw in the last leg of the rally back before Chinese New Year, with bearish daily patterns of opening highs and closing near the lows. Over the weekend, of course, geopolitical developments is likely to provide an excuse for investors to take some positions of Hong Kong-China equities. As noted, investors should be patient and wait to add to the Hang Seng Index around the 20,300 and 19,300 levels. That is all from me for today. As always, if you enjoyed the podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.